Doing real estate deals with no money using transferred corporate stock. This article is the 17th in a series of 17 articles that will give readers insights into how real estate investors are able to do transactions with little or no money, no credit and little or no risk. In this part of the series we will discuss the technique of selling the shares of a corporation. This method actually transfers the stock in the corporation to someone or another entity at or before the closing. In the heydays of condo sales, many developers wouldn't allow investors to sell their new purchased condos for months or even years. These constraints were what were called deed restrictions. Even today, FNMA, Federal National Mortgage Association, has deed restrictions on their sales of their bank-owned properties, RES. The restriction is for a 90-day period, and during this period, if the property is sold for more than 120% of the purchase price, there is a $5,000 penalty. After 90 days, there is no longer a restriction. Investors who purchase these deed-restricted properties in corporations have the ability to sell the corporate stock to a new owner without a change of ownership in the public record. The entity who purchased the property is still the one who owns the property. Some people might dispute this, and I suggest you always ask a local real estate attorney about what to do in this situation. While all this seems logical and it is being used virtually every day somewhere in America, there are potential issues for the investor buyer. A corporation is a legal entity that has to pay state income taxes where applicable, and always federal income taxes. Therefore, a tax identification number has to be issued for the corporation to function and to open a checking account. The corporation must file with its home state where it is located to file for authorization to do business. These steps take time, so